Hi, this is Juliet, the young Orfiano. Welcome to my video. If this is your first time on my channel, please like, share, and subscribe so I can notify you if I have a new video. This is the continuation of part 2 about investments in equity and debt securities. I discussed in part 2 about trading securities and available for sale securities. Just click above or the link below this video to watch part 2. In this video, I am going to discuss about the transaction subsequent to initial recognition. Transactions subsequent to initial recognition. After acquisition, the investment may be affected by miscellaneous transactions such as share split, receipt of dividends, and rights issues. Share split. Stock split or share split is a reduction in the par or stated value of share capital accompanied by a proportionate increase in the number of shares outstanding. A share split does not affect the equity of a shareholder in the issuing corporation, nor does it affect the issuing corporation's total shareholders' equity. For these reasons, no formal entry is necessary in the books of the investor to account for the share split. The investor records the receipt of the additional shares through a memorandum entry only, indicating the change in the number of shares. To illustrate the effects of a share split, assume in our preceding example that 3 months after acquiring the available for sale securities of 2,100 pesos par ordinary shares of PAT Company for a total consideration of 252,500 pesos, including transaction costs, PAT Company effected a 2-for-1 share split and issued additional share to effect the same. In the books of NITS Corporation, only a memorandum entry is taken up indicating that the number of shares held by NITS in PAT Company totaled 4,000. The memorandum entry is PAT Company affected a 2:1 share split on its ordinary shares. As a result, the entity now holds a total of 4,000 ordinary shares of PAT Company. Consequently, the adjusted recorded cost of each of the 4,000 shares is reduced to 63,125 pesos, which is derived by dividing the total initial cost of 252,500 pesos by 4,000 shares. If subsequently, during the same year, the shares are sold by the investor, the computation of the gain or loss shall be based on the adjusted carrying value per share. Assume that subsequent to the 2-for-1 share split effected by PAT Company, NITS Company sold 1,000 ordinary shares of PAT Company for 80 pesos per share, less disposal cost of 1,200 pesos. The entry in the books of NITS would be debit cash for 78,800 pesos, credit available for sale securities 63,125 pesos, gain on sale of available for sale securities 15,675 pesos, sold 1,000 shares of PAT. Net selling price 1,000 times 80 less 1,200 pesos is 78,800 pesos. Cost of shares sold 1,000 times 63.125 is 63,125 pesos. Gain on sale of securities, 15,675 pesos. Dividends. Dividends are corporate distributions to its shareholders, proportionate to the number of shares held by the latter. Dividends may be in the following forms: A. Cash dividends. B. Bonus issue or stock dividends. Letter C. Property dividends. And letter D. Scrip dividends. Cash dividends. Cash dividends are generally recognized as income when received or receivable. Assume that Chris Company owns 1,000 ordinary shares of J Company, acquired at 120 pesos per share. The shares are classified by Chris as available for sale securities. If Chris received 5 pesos cash dividend per ordinary share of J Company, the entry is debit cash for 5,000 pesos, credit dividend revenue for 5,000 pesos. If the dividends declared by the investee are to be paid in the ensuing accounting period, an adjustment is taken up by the investor for the accrual of the dividends by charging dividends receivable and crediting dividend revenue. In the example earlier, if J Company declared the dividends on December 1st, 2009, payable on January 31st, 2010, to shareholders of record as of December 31st, 2009, Chris Company would prepare the following entries. On December 1st or December 31st, 2009, debit dividends receivable for 5,000 pesos and credit dividend revenue for 5,000 pesos. On January 31st, 2010, debit cash for 5,000 pesos and credit dividends receivable for 5,000 pesos. The distribution of dividends involves 3 significant dates. A. Date of declaration. The date of declaration is when the board of directors of a corporation declares the distribution of dividends. Letter B. Date of record. The date of record is when the corporation will draw a list naming the shareholders who are entitled to dividends. And letter C. Date of payment. The date of payment is when the dividends are distributed to shareholders. From the date of declaration through the date of record, the shares sells dividends on, which means that the market price of a share includes the amount of the dividend. After the record date, shares sell ex-dividend, which is the market price does not include the amount of the dividend. A shareholder selling his securities after date of declaration but before the date of record actually sells 2 types of financial assets: the investment in shares and the dividend receivable, which may not have been recorded. The buyer, on the other hand, acquires 2 types of financial assets: the investment in shares and the dividend receivable. To illustrate, assume that Chris Company owns 1,000 ordinary share of J Company acquired at 120 pesos per share on January 1st, 2009. On June 30, 2009, J declared 5 pesos cash dividend on its ordinary shares, payable on August 15, 2009 to shareholders of record as of July 15, 2009. On July 5, 2009, Chris sold all his shares to Oli Company for 135 pesos per share. Because July 5, 2009 is between the date of declaration and date of record, the selling price of 135 pesos is selling price dividends on. Chris sells its rights to receive dividends of 5 pesos per share. The excess of 135 pesos over the dividend of 5 pesos, which is 130 pesos, is the selling price of the share is sold without the dividend. Chris therefore realized a gain of 10 pesos from the sale. Selling price per share dividends on is 135 pesos, dividend per share 5 pesos, selling price of a share without dividend is 130 pesos, carrying value of each share is 120 pesos, the gain on sale of each share is 10 pesos. The sale is recorded by Chris as follows: July 5, debit cash for 135,000 pesos, which is 1,000 times 135. Credit dividends revenue for 5,000 pesos, 1,000 times 5. Credit available for sale securities, 120,000 pesos, 1,000 times 120. Credit gain on sale of AFS, 10,000 pesos, which is 1,000 times 10. After this sale, the right to the dividend on the 1,000 shares is transferred to Oli Company, and Chris Company shall not prepare any entry on August 15, 2007. Oli Company shall prepare the following entries for the purchase of the shares and the receipt of the dividend. July 5, debit available for sale securities, 130,000 pesos, debit dividends receivable, 5,000 pesos. Credit cash for 135,000 pesos. On August 15, debit cash for 5,000 pesos, credit dividends receivable for 5,000 pesos. In some instances, a portion of the dividends received by an investor may have resulted from the investee's earnings prior to the acquisition of the shares by the investor. These dividends are treated as return of the investor's cost of investment, as the investee's earning prior to the date of the acquisition is logically considered by the original seller in setting the selling price of the shares. There are also instances when the dividend declared come from the balance of contributed capital accounts of the issuing corporation. This latter type of dividends is called liquidating dividends. In either case, the receipt by the investor of such dividends is not credited to an income account but to the investment account. Assume that Company A holds 1,000 shares of 100 pesos par ordinary share capital of Company B for 125 pesos per share on January 1st, 2009. On December 31st, 2009, B Company paid dividends of 12 pesos per share. 10 pesos comes from current year earnings and 2 pesos from the retained earnings of B on January 1st, 2009. Company A shall prepare this entry: debit cash for 12,000 pesos, credit dividends revenue for 10,000 pesos, credit available for sale securities 2,000 pesos. After the receipt of the stated dividends, the carrying value of the investment is reduced to 123 pesos per share, which is 125 pesos less 2 pesos. Bonus issue or share dividend. Oftentimes, the investee company distributes as dividend shares in the same class held by shareholders. These distributions are called share dividends or bonus issue of the same class. Distribution of bonus share in the same class of share capital increases the number of shares held by each shareholder without any change in the total shareholders' equity balance or net assets of the distributing corporation. The equity of each shareholder after the receipt of the bonus issue is also unchanged. Thus, an investor receiving a bonus issue records the transaction by a memorandum entry. The transaction merely adjusts the carrying value per share held by the investor. Assume that Chris Company owns 1,000 ordinary shares of J Company acquired at 120 pesos per share. These shares are classified as available for sale securities. Subsequently, Chris receives 20% bonus issue from J Company. The receipt of the bonus issue shall be recorded by Chris as follows. Memorandum entry, receive 200 ordinary shares of J Company representing 20% bonus issue on 1,000 shares previously held. After the receipt of the bonus issue, the carrying value of each share of J in the books of Chris will be 100 pesos, which is the total original carrying value of 120,000 pesos divided by 1,200 shares held after the receipt of the bonus issue. If the bonus issue is in the form of another class of share capital, for example, preference shares are distributed to ordinary shareholders as bonus issue, a part of the carrying value of the original investment will be transferred to the new shares received in another class. The allocation is based on the relative fair market values. To illustrate, assume that Chris Company owns 1,000 of J Company ordinary shares required at 140 pesos per share. These shares are classified as available for sale securities. A year after acquisition, J Company distributes as dividends 1 share of each 100 par value preference share for every 10 of each ordinary shares. On the date of distribution, each ordinary share sells ex-dividend at 144 pesos while each preference share sells at 160 pesos. Chris Company will therefore receive 100 preference shares of J Company as dividend. The allocation of the previous carrying value of the investment in ordinary share of 140,000 pesos is presented as follows. Class, number of shares, market price per share, total market price, and allocation. Ordinary, number of shares is 1,000, market price per share is 144. The total market price is 144,000. Allocation, 140,000 times 144 divided by 160 is 126,000. Preference, number of share is 100. Market price per share is 160. The total market price is 16,000 pesos. Allocation, 140,000 times 16 divided by 160 is equals to 14,000. Total is 160,000 pesos. The entry to record the receipt of the bonus issue is debit available for sale securities, J preference, 14,000 pesos. Credit available for sale securities, J ordinary, 14,000 pesos. Receive as dividend 100 preference shares of J on 1,000 ordinary shares of J Company. After posting the stated entry, the remaining carrying value of J ordinary shares is reduced to 126,000 pesos, with the number of shares maintained at 1,000, the revised cost per ordinary share after the receipt of the preference dividends is 126 pesos, which is 126,000 pesos divided by 1,000 shares. Property dividends. When dividends are distributable in the form of the investee's non-cash assets, the investor records the asset received as dividend revenue at the asset's fair market value. To illustrate, assume that Chris Company owns 1,000 ordinary shares of J Company acquired at 140 pesos per share. These shares are classified as available for sale securities. A year after acquisition, J Company distributes as dividends one ordinary share of Oli Company, which J holds as investment in available for sale securities. For every 10 ordinary shares of J Company, Oli Company ordinary has par value of 100 pesos and sells at 120 pesos at the time of distribution by J. The entry in the books of Chris to record the receipt of dividends, assuming that the shares will be held by Chris as available for sale securities, is debit available for sale securities, Oli Company, ordinary 12,000 pesos. Credit dividends revenue, 12,000 pesos. Receive as dividend 1 ordinary share of Oli for every 10 ordinary shares of J. Stock rights. When a corporation issues additional shares of stock to increase its capital, the additional shares shall be offered first to the existing shareholders proportionate to their holdings. This right of a shareholder to maintain his proportionate ownership in the corporation is called preemptive right. A certificate called share warrant evidences a shareholder's preemptive right. Generally, the number of shares warrants distributed equals the number of shares held by the shareholder. However, a specified number of warrants may be necessary for a shareholder to purchase a share of stock at a specified price, as stated in the share warrant. There are 3 significant dates related to issue rights. Letter A, the date of the warrants are declared and announced. Letter B, the date of the rights or warrants are issued. And letter C, the date the rights expire. From the date of announcement or declaration until the date of the rights are issued, the share and the right cannot be separately bought or sold. The shares then are selling rights on, meaning each share carries with it one right. After the rights are issued up to the date of expiration, the shares and the rights may be bought or sold separately. The shares then are selling X rights. A share warrant that is received by the investor as a result of preemptive right qualifies as a derivative as defined by IAS number 39. A derivative is a financial instrument possessing the following 3 characteristics. Number 1, its value changes in response to the change in a specified interest rate, financial instrument price, commodity price, foreign exchange rate, index of price or rates, credit rating or credit index, or other variable. Number 2, it requires no initial net investment or an initial net investment that is smaller than would be required for other types of contracts that would be expected to have a similar response to changes in market factors. Number 3, it is settled at a future date. All of the stated characteristics are possessed by the stock right. 1. The value of the warrant depends on the movement of the value of the issuing corporation share capital. Number 2. It requires no investment for the holder, as the same is received as a result of the original shares held by the investor. Number 3. The warrant is settled at a future date through exercise by the holder or through expiration. If stock rights qualify as derivative, the rule on the measurement of derivatives shall apply. Derivatives are measured at fair value, except for those derivatives that are linked to equity securities whose fair value cannot be reliably measured. To illustrate accounting for stock rights, assume that Chris Company owns 1,000 ordinary shares of J Company acquired at 140 pesos per share. These shares are classified in Chris Company's books as available for sale securities. Subsequently, during the same year, J Company issues stock rights to its shareholders, entitling the holders thereof to purchase 100 pesos per ordinary share at 120 per share for every 4 shares held. On date of distribution of the rights, each share is selling X rights at 138 pesos per share, while each right is selling at 12 pesos each. Using fair value to initially assign an amount to the stock rights, the total value of the warrants received by Chris is 12,000 pesos, which is 1,000 times 12. The entry to record the receipt of stock rights is debit derivative assets J stock rights for 12,000 pesos. Credit available for sale securities J ordinary 12,000 pesos. After recording the stated transaction, the carrying value of the available for sale securities is reduced to 128,000 pesos, which is 140,000 pesos less 12,000 pesos. The investor who receives the stock rights may either exercise the rights, sell the rights, or merely allow the rights to lapse. The exercise of the rights would mean that the investor will use the rights to purchase additional shares that would maintain his proportionate interest in the company. If in our example, Chris Company exercised all the rights received, the entry for the exercise is debit available for sale securities J ordinary 42,000 pesos, credit cash for 30,000 pesos, and credit derivative assets J stock rights for 12,000 pesos. Number of shares acquired 1,000 divided by 4 is 250 shares. Cash paid 250 shares times 120 is equals to 30,000. Thus, the initial amount assigned to the new investment is 42,000 pesos, which is the sum of the cash paid and the fair value of the rights exercised. If, on the other hand, Chris Company sells all the rights at 12 pesos per right, the entry is debit cash for 12,000 pesos and credit derivative asset J stock rights for 12,000 pesos. If Chris merely allows the stock rights to lapse, the carrying amount allocated to them is transferred to a loss account. Thus, the entry is debit loss on expiry of stock rights for 12,000 pesos and credit derivative asset J stock rights 12,000 pesos. Theoretical market value stock rights. In the absence of an actual market value of the stock right at the date of distribution, one may use the theoretical market value of the stock right as its initial measurement basis. The theoretical market value of a stock right is computed based on whether the shares sell X rights or sell rights on. When shares are selling X rights, the theoretical market value or TMV of a stock right is computed as follows. Theoretical market value is equals to market value of stock X rights minus the subscription price divided by number of rights needed to buy one share. The theoretical market value will be the amount initially assigned to the stock rights related to the shares classified as available for sale securities. To illustrate, assume that Chris Company owns 1,000 of J Company ordinary shares acquired at 140 pesos per share. These shares are classified as available for sale securities. Subsequently, during the same year, J Company issues stock rights to its shareholders, entitling the holders thereof to purchase one share of 100 pesos per ordinary share at 120 pesos per share for every 4 shares held. On the date of distribution of the rights, each share sells X rights at 136 pesos. There is no actual market value for the stock rights on this date. The theoretical market value per right is computed as follows. 136 pesos less 120 pesos divided by 4 is equals to 4 pesos. The entry to record the receipt of stock right is debit derivative assets, J stock rights for 4,000 pesos, credit available for sale securities, J ordinary 4,000 pesos. 1,000 rights times 4. Assume instead that on the date of distribution, there is no known market value for either the share or the stock right of J Company. But a day before distribution of the stock rights, the ordinary shares sell at 140 pesos per share. The market value of the share rights on is 140 pesos, which means that 140 pesos is the total market value of one ordinary share and one right. Thus, the theoretical market value of one stock right of J Company is 4 pesos, computed as follows. 140 pesos less 120 divided by 4 plus 1 is equals to 20 pesos divided by 5 is equals to 4 pesos. The entry to record the receipt of stock rights is debit derivative assets, J stock rights for 4,000 pesos and credit available for sale securities, J ordinary 4,000 pesos. 1,000 rights times 4 is equals to 4,000 pesos. Any unexercised and unexpired warrants at end of the reporting period are measured on the statement of financial position at fair value. Thus, assuming that the warrants received by Chris remain unexercised and unexpired at year end, at which date market value is 5 pesos. Chris will prepare the following entry. Debit derivative assets, J stock rights, 1,000 pesos. Credit fair value gain on derivative assets, 1,000 pesos, which is computed as 1,000 rights times 5 pesos minus 4. Dividends, share split, and stock rights on trading securities. Similar procedures are applied when dividends and share splits relate to the trading securities. However, when stock rights are received on shares classified as financial assets at fair value Through profit or loss, there is no need to value the derivative assets separately because they belong to the same current asset account and are both measured at fair value, with change in fair value taken to profit or loss in the statement of comprehensive income. Thank you for watching my video. I hope you learned something from this video. I did part 4 and continuation of this video wherein I discuss in part 4 about the measurement and presentation in the statement of financial position trading securities. Just click above or the link below this video to watch part 4. Don't forget to like, share, and subscribe on my channel so I can notify you if I have a new video. Once again, this is Juliet Yang Orfiano. See you on my next video.